Good morning, good afternoon, good evening to everybody. My name is Michelle. I'm the Executive Director of the Financial Management Association. We're very, very pleased to partner with the Finance, Economics, and Banking Research Network. We call ourselves FEBRN, to host today's seminar. Today's seminar is actually the ultimate seminar. It is the final seminar of the spring 2024 semester, and we're going out with a bang. We've got David Hirshleifer here today from USC. He is a good friend of this network, a good friend of FMA. He's actually an FMA fellow as of October of last year. And today is going to be talking about social finance and some of his most recent research. I've been reading up on some of your research, especially on NBER lately. Very interesting papers that you have produced. Today's moderator is Professor Manuel Armada, and he is going to get everything kicked off with an introduction of our presenter today. A few logistical notes. We are recording this seminar, but that is subject to review by Professor Hirshleifer. So if we get a nod from him, then we will post that on the FMA online YouTube site after this. So if you're looking for a recording, it will be posted as soon as we get approval. There's a Q&A module. If you're on a laptop or a computer, it's on the bottom of your screen. If you are on a mobile device, it's somewhere on your screen. Please feel free to drop questions in as the seminar goes on. And our host and our moderator will go ahead and moderate those questions following the seminar. So with that, Professor Armada, I give you the floor.
Okay, thank you, Michelle. Good afternoon to everybody. So it is my role to introduce David, a longtime friend. Well, it is so embarrassing to introduce David. Everybody knows David, for sure. But let me say a few things about his CV. He's a fellow and former president of the American Financial Association, co-editor of the Journal of Financial Economics, and executive director of the Review of Financial Studies. Also director of the American and Western Financial Associations. His papers focuses on interplay between individual behavior and broader social influences, providing insights into how biases and social dynamics shape economic and financial phenomena. He won various research awards, including probably an important one, Smith-Britton Award for Outstanding Paper in Journal of Finance. Keynote plenary speaker at many international conferences, some of which I did attend. He was previously on the faculties of UCLA, Michigan, Ohio, and received a PhD from Chicago. Please, David, we are waiting for you, listening and seeing what you are going to say about social finance to infinity and beyond. The screen is yours, David.
Thank you very much, Manuel. I'll just do a screen share here. And thank you so much for that very warm welcome, which I very much appreciate. And thank you also for moderating this, and Michelle for managing this. So as Manuel just said, this talk is about social finance to infinity and beyond. We'll see if we can actually go beyond. Now, I'll mention that this talk has some relation to my 2020 presidential address to the American Finance Association. That talk was about social transmission bias in economics and finance. So there is some overlap, and the talk I'm giving today is briefer, but also broader than that other talk. But if you're interested in slides, those are available for that other talk. I can also make them available for this talk, but if desired. But this is the web address for that other related talk. So I would argue that social economics and finance is a nascent field with great promise. So a missing chapter in finance theory consists of the social processes that shape economic thinking and behavior. The field of social economics and finance takes into account those processes. So it studies how social interaction affects economic outcomes, recognizing that people observe each other, which is one kind of social interaction, and they talk to each other, which I take to include textual interaction or electronic interaction. It covers socially emergent phenomena, and I will explain later what I mean by social emergence. And this is already a rapidly growing and vibrant new paradigm. And so paradigm shifts can even be revolutionary, as in this image. So let me compare with existing understanding in finance. And of course, there's classical finance in which all agents are fully rational, or markets behave just as if they were. And then there was, and continues to be, behavioral finance. And you're all familiar, I believe, with behavioral finance, the application of psychology to understanding financial markets, which, of course, I think is very important. But a limitation is that the path from our assumptions to our conclusions in behavioral finance are often very direct. So, for example, there are several empirical observations that investors seem to trade too aggressively, that they buy lottery stocks, that they sell winners more than losers, the disposition effect, that they may save too little for retirement, and that investor expectations seem to rise after price run-ups. And so in behavioral finance, there are models, some by myself, where there are assumptions about investor biases or preferences that fairly directly induce these effects. And you've probably come across some of these models that are based on overconfidence or overextrapolation, or a preference for skewness, realization preference, present bias, and so on. And actually, going back, just to take one example, we see investors trading too aggressively, then we might conclude, well, investors are overconfident about their private information signals, and that causes them to trade too aggressively. So that's a very direct explanation. And sometimes the most direct explanation is the correct one. On the other hand, there's a risk of overfitting when, for each empirical phenomenon, we have a rather direct explanation that corresponds to it. Furthermore, in general, some person or even some animal being attracted to a behavior and following that behavior is not equivalent to that organism having a preference for that behavior or a belief that that behavior is desirable. So as an example, moths are attracted to flame, and they're also elimination. And for some reason, my video is not functioning on this slide. It was when I checked it. But this is a video of moths flying around a light bulb. So moths are attracted to flame or to light bulbs, but it's not that moths are flame loving. It's not that moths have some enjoyment from having their wings be singed by fire, nor do moths have any belief that the closer you get to fire, the better off you are. Instead, the moths approaching flame or light bulbs is occurring because moths have navigation systems that can be fooled. So their navigation systems are based on motion relative to distant light sources, such as the moon. And that's how their navigation systems evolved. And the problem is that these navigation systems can be fooled when the light source is actually nearby, as with a light bulb. So the true explanation for why moths are attracted to flame or are attracted to light bulbs is indirect. It's not just that there's a direct preference or direct belief in approaching light bulbs. So in the context of social interactions, there's another kind of indirect effect, which I call social emergence. And this is where social interactions generate indirect effects on behavior. So specifically, social emergence is the phenomenon that aggregate outcomes are not just the sum of individual propensities. And to illustrate this, I'll give the example of death spirals in army ants. But you can picture these ants, this swarm of ants, marching around in a circle. So this is called an ant spiral, and ant spirals are sometimes hundreds of feet wide. And the ants will often continue to walk in a circle for days, until they die of starvation. So this is clearly not a functional behavior. So what's going on here, the direct explanation is clearly wrong. So the direct explanation would be that ants have some kind of instinct to walk in a circle, that they maybe have a preference for walking in a circle, or a belief that marching in circles is desirable. But the actual explanation is indirect. This is a socially emergent phenomenon. So what happens is that ants have an instinct to follow other ants. So an individual ant may locate a good food source. And because of that, there's a selective benefit to another ant to follow the path of the first ant. And this works through pheromones. And so this can work pretty well, but occasionally there will be an ant that's at the back of a line of ants, and the ant at the front of the line has curved around and starts following the ant at the back of the line, so that the ants start walking in a circle. And when this happens, you can get this dysfunctional phenomenon where entire crowds of ants are just marching in circles until they die. So the new paradigm of social economics and finance, it takes into account such socially emergent effects. So I'll argue that what comes after behavioral finance is an understanding of social transmission and social emergence. And when I say it comes after behavioral finance, I don't mean that we should forget all the lessons of behavioral finance any more than we should forget the lessons of classical finance. But it means that we have to consider a new paradigm which takes into account effects that are not reflected in traditional behavioral finance. So as an example of some stylized facts that can be addressed with social finance and social economics and finance are that cultural attitudes and moral and religious attitudes affect economic behavior. So they affect such phenomena as corruption, quality of government, economic growth and development, affects the behaviors of both firms and individuals. I have this long list of behaviors where there's evidence that these are affected. I won't go individually through these items. And there's evidence that religion in localities, or the religion of managers, and the political attitudes in these localities or of these managers, and culture affects the behavior of firms in risk-taking behavior, investment behavior, occurrence of unethical practices, stock price outcomes, and so on. So a fundamental fact about people is that we socially acquire our beliefs and preferences. And so even in those situations where, as in traditional finance, the path from belief biases or preferences to financial outcomes is fairly direct, there is still the question of where do these biases and preferences come from? So in behavioral finance and in economics and in classical economics, these are taken as exogenous. At least the preferences are taken as exogenous in the prior beliefs. However, preferences and belief biases vary across countries, across cultures over time. And so there's extensive evidence of such variation in discount rates, risk tolerance, degree of overconfidence, and many other behavioral biases. They are culturally malleable. And that means if we want to understand this variation in human beliefs, biases, and behaviors, we're going to gain predictive power for economic outcomes. So that means that we want to understand where biases and preferences come from. Such an issue is central to economic behavior, and therefore it should be studied even if this crosses disciplinary boundaries. So it's important to endogenize the evolutionary processes that shape culture and that shape economic behavior. So some key intellectual building blocks of social finance include first the concept of social networks. I'd say this is the concept that will probably be most familiar to most of you. There's been very extensive attention to and publicity to the concept of social networks appropriately. And what I'll emphasize a bit more, because it may be less familiar, are two other concepts: folk economic models and social transmission bias. So as for folk economic models, these are understandings of the world that are not necessarily correct. And these can be mundane beliefs about correlations between variables or about what causes what. They can be very simple belief units, or they can be entire elaborate idea systems, such as, for example, the growth investing philosophy in finance, a story that involves cause and effect sequences of events over time. The third major building block is what I call social transmission bias. And I'll define and say much more about social transmission bias soon. So first, what are folk economic models? Well, to start with, a folk model in general is an understanding of how the world works. So for example, belief in heaven and hell is an understanding of how things work. In the finance context, there are beliefs in return continuation, as with the Wall Street saying, the trend is your friend. But some people have the opposite belief in reversal, as with the Wall Street saying, buy on the dips, that you should bet on reversals in stock price movements. So there are different folk models of how the world works, and these different beliefs can spread from person to person. And the way they spread is influenced by biases in transmission. So it's not just that we rationally adopt the ideas that are best, there are also biases in the process, which I'll say more about. So there's competition between different folk economic models. So I described how the trend is your friend is a belief in continuation of returns, but buy on the dips is a belief in reversal in returns. So these ideas compete to invade human minds. And this competition endogenizes behavioral bias. So in behavioral finance, an individual's belief in extrapolation, I should say continuation or reversal, is taken as given. But in social finance, these competing beliefs can spread contagiously, and we can endogenize who has what beliefs. Social transmission bias is the systematic modification of signals, ideas, or behaviors that people have when they are transferred between individuals. So the person who starts out with a certain idea or signal, we call the sender, and then the person who is infected with these ideas, we call the receiver. This sending and receiving can occur through conversation, or it might just be through observation, that the receiver observes the behavior of the sender. Biases come from both the sending side and the receiving side. Incentives affect what senders send. Psychological biases affect what senders send and what receivers receive. So I argue that this is an underexplored foundation of human beliefs and especially of the resulting economic behaviors. So social transmission bias can take the form of signal distortion or of selection bias, or at least these are two major categories of social transmission bias. So signal distortion can take the form of a shift in the sign of the signal. So you believe X, and I start believing the opposite, minus X, or the intensity of what gets transmitted. So maybe there's exaggeration of the signal. You believe X, I believe 2X, or I believe 0.5X. So that's distortion of what gets sent. There's also selection bias in what gets sent. So there are biases in whether something gets transmitted from one individual to another. So as one example, there's evidence of so-called echo chambers, where receivers tend to acquire signals from like-minded senders. So if I believe something and you have a further signal that this is true, then I pay attention to your signal. Whereas if you have the opposite signal, I may ignore your signal. So that's a selection bias in what information gets incorporated by the receiver. So the goal of social economics and finance is to build on standard ingredients such as preferences, optimization, beliefs, psychological bias in those beliefs, the concept of equilibrium. As in behavioral economics, we want to have well-motivated assumptions based on the psychological evidence and based on evolutionary plausibility of where did the human mind come from. And then we want to capture systematically and tractably socially emergent effects as well as direct effects. So I mentioned three major building blocks for social economics and finance. I'll say just a little bit about social networks. So I've argued that there's contagion in financial behaviors and markets. There are rational models of such contagion, as in, for example, models of information cascades. There are imperfectly rational models of contagion that have been extensively studied. There's extensive evidence of that beliefs and behaviors do indeed get transmitted for financial behaviors in particular, such as trading stocks, trading particular stocks, participating in the stock market, other kinds of investing behaviors and saving behaviors, and the behaviors of firms as well as investors. There's extensive evidence of the transmission of information about securities between investors, which has also been modeled. So such transmission occurs along social networks where two individuals observe each other or talk to each other, then they are linked in the social network. There are emergent effects of social network characteristics. And so I'll give an example from one model in finance that is a model by my co-authors and myself, finds that because of social transmission bias, that people overconsume. And there's no individual propensity to overconsume, but there's this transmission bias also, there's a positive feedback effect that occurs because of interactions in the social network. And this positive feedback effect is exaggerated for agents that are more central in the social network. And also, if people in general are more heavily connected in the social network, that also exaggerates the effect. So this causes greater per capita overconsumption. So this feedback effect is inherently social, and it's conditioned by the nature of the social network. Okay, so that was just a quick example of the importance of social networks. Now let's go on to the second major building block, folk economic models. So how do we understand swings in investor sentiment? Well, one possible explanation is that there are shifts in the popularity of folk economic models. So for example, people may suddenly decide by talking to each other or through social media that it's great to buy fancy consumer products, or the opposite, that it's very important to save right now. That would affect savings outcomes. They're spread on websites such as Seeking Alpha or StockTwits of ideas about the value investing philosophy versus the growth philosophy, or about the advantages of day trading, which can affect the returns on securities or on factors. There's discussion about the excitement of speculation. So on Reddit, for example, discussions of meme stocks and how great it is to speculate in them versus the urgency of safety. This can lead to market booms, as with the GameStop bubble, or the opposite, flight to safety. And as emphasized by Robert Shiller, there are ideologies saying that we live in a new investing era, which can, when these become popular, can lead to bubbles in the stock market or real estate. So an example of how you can model the effect of transmission of folk models to financial investing and financial market prices is you can apply compartmental models from epidemiology to the spread of folk models. So some of you have probably come across these compartmental models in epidemiology, such as the famous. And to apply this to finance, we could have a folk economic model which says that a certain asset, maybe GameStop, has excellent prospects. Maybe this asset is Bitcoin, for example. So the SIR model from epidemiology initially has a positive feedback effect. So if you start with few infected individuals, as more people get infected, there are more and more random contacts between infected individuals and uninfected individuals. There are more people to get infected from. And this greater contact causes the rate of growth in the number of infected people to start rising more and more rapidly. So what you get is an epidemic rise and fall time path, which has been modeled in economic contexts as well. So here's a graph of the SIR model. I won't go into details, but if you look at this blue line, you can see that the rate of increase in the number of infected people at first is slow, but then it accelerates as there are more and more infected people to spread the infection. And of course, as most of the population or a higher fraction of the population becomes infected, there are fewer remaining people to become infected. And so the rate of increase slows down later. But you get this bubble looking like path where you have explosive growth for a while. Now, when I have extended compartmental models to the stock market, I added a further ingredient, which I think is realistic in a stock market context, which is that there can be growing excitement. So when people are talking about a new cryptocurrency or Bitcoin, let's say, then there can be growing excitement about it, which actually increases the contagiousness of the folk model. So people are hearing about Bitcoin, but they're also hearing that a lot of other people are adopting Bitcoin. They're hearing about a high rate of growth, and that can make adopting the Bitcoin ideology more attractive. And so it can increase the effectiveness the infectiousness of the Bitcoin idea. If we add to the spread of this Bitcoin folk model a standard mean variance stock market model, then the effect of what I call buzz, this growing excitement, is that it amplifies a boom on the way up. It amplifies the collapse on the way down. So it increases overshooting. And because of this overshooting, you get stronger oscillations, though these oscillations, it turns out, become damped over time. So you get a rich pattern of serial correlations in stock returns over time and at different lags, which is kind of reminiscent of the empirical fact that you have momentum in stock returns at short lags, but you have reversals at long lags, and you have reversals at very short lags as well. So here's a graph of a deterministic version of a stock market model with excitement about a folk model, and where there's excitement about buzz. And so you can see here a stock market bubble that collapses, but there's overshooting, so it rises again in this pattern of damped oscillations. So with that, I'll go to the third major building block of social economics and finance, which is social transmission bias. And I'll describe a model of the effects of transmission bias. In this model, we consider several social transmission biases, but what I'll focus on is what we call self-enhancing transmission bias. And so self-enhancing transmission bias is where I pass on information that makes me look good, but I don't pass on information that makes me look bad. So in our model, there are two stock market investing strategies, A for active and P for passive. You can interpret the active strategy as having higher variance or maybe having higher skewness. And so investors of type A or P are randomly selected to meet, and this keeps happening repeatedly over time. One of the investors is randomly chosen to be the sender, the other the receiver. And the sender has some probability of reporting the profit that the sender has experienced from her investing strategy to the receiver. Self-enhancing transmission is, in this model, is that the higher the return you've experienced, the more likely you report your return performance to the receiver. So that makes you look good. Receivers have a standard behavioral bias, which is that they do not adjust for selection bias in the information they receive. In this case, the selection bias is that they're hearing about the high returns on strategies much more often than they're hearing about the low returns. They also think that past performance is strongly indicative of future performance, which is on the whole not true in the stock market. The effect of this is that for receivers, there's a strong upward selection bias in the return reports that they receive. And this selection bias is stronger for the high variance strategy than the low variance strategy. So if you look up at this figure, here's a picture of a high variance strategy, so a wide range of returns, and the heavily reported returns are on the upper end. And you can see that the high variance strategy generates a lot of very high returns that often get reported. And there are a lot of very low returns that do not get reported. For the low variance strategy, this effect is present, but it's much weaker because the range of returns is smaller. So the effect of this social transmission bias is that the high variance strategy A can spread through the population. And that can be the case even if A has lower expected returns on average. So in equilibrium, because of this social spread in the strategy A, that drives up its price. So for example, high volatility stocks, they get driven up in price. And that means in equilibrium, they have low expected future returns. So this model then can explain the anomaly of active trading, that retail investors trade very actively and lose money thereby. and the volatility and beta return anomalies. There's also strong empirical support for self-enhancing transmission, that investors are indeed more likely to report their high returns than their low returns on social networks. Now let's add one variation to this model, which is that there is high salience of extreme returns. And it turns out when there's high salience of extreme returns, then positive skewness strategies also tend to spread through the population. So these effects can also explain the so-called lottery stock return anomaly. So some lessons we can take from this. Investors here are attracted to variance and skewness, but in the model, they don't have any preference or liking for variance or skewness, nor do investors have any belief that high variance stocks or high skewness strategies present a good investing opportunity. Indeed, the investors may be completely unaware of variance and skewness. Instead, they are attracted to it. It's a socially emergent effect. Investors are attracted to it because of the bias in transmission. And this fact that they're attracted to it rather than that they're socially attracted to it rather than having a belief in it or a preference for it has distinctive empirical implications about what personality traits lead to this kind of investing, the effects of social network position, and the effects of social network connectivity. Another model, the same set of co-authors of the effects of transmission bias is on visibility bias and overconsumption. And so our starting point in this model is that engaging in a consumption activity is often more visible to others than not consuming. So for example, this was the opening of a new Starbucks in a city in China, the first Starbucks. People were lined up to buy an expensive cup of coffee, and it was highly visible that people were doing so. Advertisements also make consumption visible. What if observers do not appropriately discount that they're learning that the norm is to consume heavily? They think that they're learning that high consumption is a good idea. Once again, this is a socially emergent effect. There's no direct behavioral bias in the model for overconsumption. For example, people don't have any self-control problems. And this fact that this is socially emergent has distinctive social, empirical, and policy implications. For example, a key implication is that disclosure can help reduce overconsumption. And this contrasts, and there's empirical support for this implication that disclosure of how much others are consuming can actually reduce overconsumption and reduce spending. And a third example of the effects of transmission bias is a solo model of mine on biased information and bubbles. So it's a model of the feature of booms and bubbles that sometimes they seem to extend beyond all reason. And in this model, investors are repeatedly meeting and sharing signals. In each meeting, when I pass my signal on to you, some small bias B is added to the average signal that I convey. I might be doing it, I might be exaggerating my signal, or maybe the receivers are biased and for some reason add just some very small bias. There's continuous trading over time, and I also allow for public signals to arrive intermittently. We can think of those as earnings news announcements. It turns out in this model that there is recursive amplification of bias. So investors meet, and then there's a bias that's induced. Now, here's this investor who's now upward biased and meets someone else. Now an additional bias is added on. So you get this recursion where the bias gets added on again and again and again. So the biases accumulate and become larger and larger. So overpricing in the model starts out slowly, but accelerates. And this occurs even if there's a very small transmission bias. Eventually, it will have large effects. On the other hand, reality eventually intervenes because there are these earnings announcements that convey unbiased information about how much the stock or the market is really worth. All of this that's going on, these bubbles and these corrections in this model, are emergent effects. The model does not contain any of the usual behavioral finance ingredients of bubbles, such as overconfidence or overextrapolation. So here's a graph of the expected path of the stock price in this model when there's a small positive bias. First, look at the black curve. That's a smooth version of the expected price path. So you've got a boom and you've got a collapse. But what actually happens is more interesting, is that you have these booms that are even more extreme, but each time there's an earnings announcement that gives some unbiased information, there's a downward jump. So there's a downward correction in the price. And so you get this zigzag effect, or a sort of stegosaurus graph. You'll also notice that the zigzags are much larger at the peak than they are early on in the bubble or later on in the bubble. So I call that phenomenon peak oscillation. And it occurs because of this tug of war between biased information percolation and the correction that's coming from public news arrival. There's also a pattern that fits with the Wall Street phrase dead cat bounce. So we can see that as the bubble corrects, you get these upward jumps as well. So you can get dead cat bounce in this model. And this mechanism is potentially consistent with a whole range of trading and return anomalies, including, for example, short-term momentum and long-run reversal. So summing up, because of social transmission and social transmission bias, we get the phenomenon that I call mimicry, which is there can be an illusion of a direct behavioral bias when such a bias is not actually present. So it's perilous to draw naive conclusions from the data. Social outcomes, such as stock market bubbles, easily create the illusion of a propensity for a behavior when this does not exist. So we saw a model where it looked like there were lottery preferences, but it was actually coming from self-enhancing transmission bias. People did not have any preference for lottery stocks in that model. They were just attracted to them. And it can seem like there may be bubble-inducing biases such as overconfidence or overextrapolation, whereas actually there's just bias in information percolation. So we often overstate the inferences that can be drawn from empirical tests in behavioral finance. Social finance draws upon new test variables, so it suggests new directions for empirical work. So for example, there are general measures of social interaction, how sociable people are, what communication technologies they use, position in the social network, characteristics of the social network. Or there are sources of social transmission bias, psychological traits, environmental cues, the incentives to convey some kinds of information and not others, the contents of folk models. Textual analysis is extremely promising for analyzing, empirically studying social interactions. And so I'll close by emphasizing that the opportunities in this field, in this new paradigm, seem almost unlimited to infinity and beyond. So social economics and finance offers a new direction for understanding markets, which is now discernible with the key building blocks that I've described today: social networks, folk models, and social transmission bias. Thank you very much.
Thank you very much, Professor Hirshleifer, for the presentation. We now move to a period of questions and answers. But before that, thank you for your willingness to share the slides at the end of the seminar. I believe that the more than 200 attendees that we have today will be very pleased to have the slides by the end of this seminar. I will start by, and following even your presentation, there is extensive research which indicates that social transmission is biased, that certain types of information tend to survive better than others, thereby shaping cultural change. So what is your opinion in terms of this social transmission bias in the environment of the financial markets? So is it more important, start being relatively less important when we are in algorithm trading and artificial intelligence that tend to substitute traders? So how you see the combination of this social transmission bias with this new environment that we have in the financial markets?
Well, I'd argue that the modern electronic environment has in many ways greatly increased the effects of social transmission bias, that it has made some biases stronger and intensified them, and also introduced new types of bias. So one example, I mentioned self-enhancing transmission, where people talk about their good outcomes, where their strategy did well, and they are quiet when their strategy did badly. Now, when I'm talking to friends in person about my investing strategies, I might be inclined to admit when I lost money with close friends. But if I'm just communicating far and wide in a blog post or in a social media posting, then I might be more inclined to hide things that could reflect badly on me. So there's also, there's reason to expect that such a bias may be intensified because of social media. Another example, I mentioned visibility bias in consumption, where when I buy a boat, my neighbor sees it in my driveway. If I don't buy a boat, my neighbor doesn't notice anything in particular in my driveway. So that's a bias that my consumption is highly visible. Well,
We lost.
on social media, people love to post about, and so that can intensify that kind of bias. In addition, there are opportunities for amplification, because if a new investing idea is exciting, so if cryptocurrency is very new and exciting when it was, then the very fact that it's a sexy investment can make people more likely to pass that on. And I think that such an effect is quite strong in social media. Now, what kinds of transmission biases are going to be introduced by AI? That's an open question. We have such an explosive growth in functionality. Things are changing by the day. But my impression right now of AI is that it's very good at reflecting the conventional wisdom and passing it on. But at the same time, we can see biases, and these biases don't perfectly match the biases of humans. So to take a trivial example, AIs currently seem to love the word delves. And so again and again, the AI will say, we will now delve into this issue. And it seems for some reason, current AIs, or several of them, have a bias in favor of that word, which spreads the use of that word. Well, in a similar way, AIs may have a bias in favor of one stock over another, maybe for reasons that we don't yet understand. The last point I'll say, because this was a very rich question that you asked, is that AIs currently are being trained, or historically have been trained on human text and data. But now human text and data is being influenced by AIs as people use AIs to generate their tests. And so this creates the opportunity for a feedback loop. And from such a feedback loop, there can be explosive positive feedback. And so there's a possibility that that could feed into economic behavior and financial markets explosively.
Thank you. Thank you very much. I will move to another question, and this one shorter, the question, but not sure about the answer. From Andre, which he asked, what are the possible data sources to study social emergency? So basically, social media network data has been utilized extensively in the literature, but are there other data sources that might be useful to study social emergence?
Yes, there are a variety of data sets, and my AFA presidential address was published in a 2020 paper, which mentions some of these data sources. I think there's a need for a more systematic discussion of that. So there's excellent work by Kuchler and Strobel on social finance, which discusses data sources, and there are other surveys. So there's, let's see, I guess rather than just listing papers, I'll mention that there is a Facebook data set, which is becoming more and more extensively used, and which is an extremely rich source of information. And there are investing social interaction sites such as Seeking Alpha and StockTwits. And but there are certainly opportunities for scraping the web for textual data as well. And I'd say that more and more such data sets are being developed and are becoming available.
Thank you. Thank you very much. A topic about replication issues. So studies on social transmission biases often face replication issues, meaning that the results observed in one study are not consistently observed in other or subsequent studies. How do you think that this situation can put potentially in question some of the results, or is not so much of the concern? What is your opinion about the potential replication issues that we have in social transmission biases analysis?
So as far as applications to economics and finance, if we're talking about studies of social transmission in economics and finance, I'm not aware of there being any special replication issue. I mean, I think that there's a replication issue in science in general. So in social psychology, there's a notorious problem of replication, the so-called replication crisis. But as far as tests for social transmission bias in financial markets, I'm just not aware of any particular especially bad problem. As just one example, I had a slide earlier which provided evidence of self-enhancing bias in transmission in financial markets. And it was a list of roughly 6 papers, which had all found, essentially all of them had found that there was a bias toward the transmission of high returns more than low returns.
Thank you. Thank you very much. Now we have one of our attendees, José Costa, which call himself as a ESG researcher. How does it affect the sustainable investment process if it could be linked with a theme that we discussed today in terms of ESG and transmission bias? That's basically, as far as I understand, what he meant to ask.
I think that's a very interesting direction for study. One thing that leaps to mind is folk models of how the world works and the spread of those folk models. And so one understanding of how the world works, for example, and Alex Edmonds has done tremendous work on probing misunderstandings about sustainability and ESG investing. So one understanding is that if you if you make investments that are socially good, it turns out to be more individually profitable as well, and therefore that there are no trade-offs. And on theoretical grounds, that seems doubtful. That is, if there's a set of investors who are motivated by more than just profit, who buy the same stocks or sell the same stocks as a group, that will tend to push the prices against them, and therefore expected returns will be lower. So theoretical grounds suggest that there would be a trade-off. But on the other hand, there's a belief that no such trade-off exists, which some people have adopted and some people haven't. So it would be interesting to analyze the spread of that belief. What causes that belief to be transmitted? Is it, for example, a wishful thinking bias in transmission, that if I want to believe something, then that makes me more ready when someone tells me that idea to adopt it? Or does it make me more eager to talk about that idea? In a similar way, of course, there are many aspects to sustainable investing and many different folk understandings about how the world works.
Thank you. It's 6 p.m. in Denmark and 10 a.m. for Michelle, and 9 a.m. or midday to Michelle and 9 a.m. for you. Do we have still time for one extra question, a final one? Is that okay? Yeah. There is one attendee that right. I noticed that there are some papers about the network effect in complex financial system. The complex system were representing a concept which is originally from physics. Do you think that your work can somehow be combined with or fit into this literature?
So I've done some amateur study from those models, which I would hope some of those ideas that are not fully integrated with ideas in the so-called mainstream of finance, I would hope for more integration. And in particular, some of these models do involve social transmission. So I think that there are valid directions coming from econophysics that, and it will be very interesting to integrate such approaches. I think that there's a sociology of science kind of challenge there, which is that economists like approaches where people have some goals and are trying to achieve those goals. So rather than being automatons or simple mechanisms, people may not be perfectly rational, but they're trying to achieve their goals, and they're trying to do something reasonably sensible to achieve those goals. And so for some econophysics models are so mechanical that for the economist, it immediately raises the question of, would these effects still be going on if people were at least halfway reasonable in pursuing their goals? And so I think that for greater integration of the fields, we need more answers to that type of question.
Thank you very much, Professor Hirshleifer. I think that it's time to finish. We still have more 13 questions that I didn't have the opportunity to pass to you today, but Michelle and FMA will send all the questions by email, so you can go through them and then you do whatever you want, reply or not. But thank you very much for accepting our invitation on behalf of FEBRN and FMA International. And we were very pleased that even with the time difference that you were willing to be with us today. Michelle, Professor Manuel Armada, some final words to, you want to say something?
Just to echo your thanks to David today. Very, very interesting research, and clearly, lots of future implications on this very topic, just as you can see from the questions that we received. As Cesario mentioned, yes, we will pass on any unanswered questions to Professor Hirshleifer after this. Oh, another one just came in.
Exactly.
So we'll make sure that he gets all of them. We're taking a short break for the summer, as most seminars are, but we will be back in full force in the fall. Professor Armada,
Okay.
anything else?
No, thank you, David, and all of you. Thank you very much.
Thank you all. Thank you all so much.
Thank you
It's
very
been
much.
my great pleasure.
Thank you. Thank you very much.
Thank you. Have a great day.
You too.